All right, let's talk about the Indian financial system. Now, I know it sounds super complex, right? But what if I told you it's basically the invisible engine room of the entire country? It's this amazing network of pipes and valves and fuel tanks that keeps the whole economy humming along. So let's pop the hood and see how it works.
I mean, have you ever really stopped to think about that? What actually prevents a huge, complicated economy from just seizing up? It's not just people buying and selling stuff. Underneath it all, there's this hidden architecture, a system designed to manage the flow of money. And understanding that system is exactly what we're going to do today.
So here's our game plan. We'll start with the big picture, the engine room itself. Then we'll zoom in on your bank, the part you already know. After that, we'll look at the central bank's powerful toolkit, see how the nation fuels its biggest projects, and then finally, we'll connect all the dots to see why this whole machine matters so much to you. Okay, first stop, the engine room. The main thing to get is that the financial system isn't just one thing. It's a whole bunch of interconnected parts. Everything from your local bank branch all the way to the stock market. And they all have to work together perfectly to keep the economy moving forward.
So, where do we even begin with a machine this big? Well, let's start with the part we all use every day, our own bank. This is really the foundation of everything, the entry point where our money gets into the wider system.
So what is a bank, really? At its core, it does two incredibly important things. It takes in money from all of us, the public, and then it pools that money together to lend it out or invest it. But the golden rule, the thing that makes it all work, is that our money is always repayable on demand. That's the core loop of the whole system.
You know, banks do a lot of things. They have secondary functions, the nice little extras like safety deposit boxes or wealth management. But the primary functions, that's the real heavy lifting. We're talking about accepting our deposits, lending that money to someone else, and in doing so, actually creating credit. This is what truly drives the economic engine. Okay, so if all the commercial banks are the individual musicians and a giant orchestra, then who's the conductor? Well, that would be the central bank. In India, it's the Reserve Bank of India, or the RBI. Think of it as the main control valve, the one in charge of the tempo and the volume for the entire economy, making sure everyone plays in harmony. So how does this conductor actually do its job? Well, it has this incredibly powerful toolkit, and it's basically split into two different categories. You've got quantitative tools, which control the volume of money in the economy, and qualitative tools, which control its direction. Let's start with volume. The very first tools in the kit are the reserve ratios. And this is a fundamental rule of banking. A bank can't just lend out every single rupee it takes in. No way. It has to keep a certain percentage in reserve, just for safety and stability. And this isn't optional, it's a hard and fast rule. The first of these reserves is the CRR, the cash reserve ratio. Right now, it's at 4.5%. That means for every 100 rupees you deposit, the bank has to send 4.5 of them in cash to be parked with the central bank. Now here's the kicker, the part that really matters to the banks. They earn zero interest on this money. It's purely a control measure, not an investment. Then there's the second reserve, the SLR, or statutory liquidity ratio, and this one's a lot bigger, at 18%. This is the portion of deposits a bank has to keep with itself, but it has to be in super safe, liquid assets. We're talking cash, gold, or government bonds. Think of it as the bank's own personal, immediate safety net. Next up, let's talk interest rates. Now, the one that affects you and me the most is the repo rate. Right now, it's at 6.5%. This is the rate commercial banks pay to borrow money from the central bank. And why does that matter? Because if this rate goes up, you can bet the interest rates on our home loans and car loans are probably going to go up too, which means we all spend a little less. The other rates here all work together to manage the system, but that repo rate, that's the one to watch. The last big quantitative tool sounds a bit complicated, open market operations, but the idea is actually super simple. Think of it like a giant tap for money. When the central bank wants to pump more money into the economy to get things moving, it buys government bonds from banks. When it wants to slow things down and fight inflation, it does the opposite. It sells those bonds, which soaks that extra cash right out of the system. And remember those other tools, the qualitative ones? Well, these are less about brute force and more about guidance. The central bank can use what's called moral suasion, which is basically just persuading banks to lend to specific sectors like agriculture. Or it can set limits on lending, and if banks don't listen, it can even punish them. It's the conductor giving a very pointed stare to one of the musicians. Okay, so everything we've talked about so far mostly deals with the short-term flow of money. But what about the really big stuff? How do we fund giant long-term projects like new highways, factories, or power plants? For that, we need to look at a completely different part of the engine, the capital markets.
Now, the capital market is really split in two. First, you have the primary market. This is where new stocks and bonds are literally born. When a company has an IPO, an initial public offering, that's happening in the primary market. Then you have the secondary market, which is what we all think of as the stock exchange. That's where all those shares and bonds get bought and sold between investors day in and day out. And this market is a whole ecosystem, right? You've got the government issuing bonds, corporations issuing shares, and then a whole army of financial intermediaries like merchant bankers and venture capital funds that help make the whole thing work smoothly. It's a massive, complex structure.
So why is this part of the engine so unbelievably critical? It's actually quite simple. The capital market takes all the nation's savings, from our little piggy banks to big investment accounts, and it channels that money efficiently into productive long-term projects. It's literally what builds the country's future. It is the high-octane fuel for growth. Okay, deep breath. We've looked at all the individual components of this massive machine. Now, let's put it all back together and see how it works as one single, powerful system.
You know, when you boil it all down, it's actually a pretty elegant design. The commercial banks are the pipes, circulating money for our everyday needs. The central bank is the main valve, controlling the pressure and the flow to keep everything stable. And the capital markets, that's the long-term fuel tank, providing the raw energy for big, ambitious growth. Every single part is absolutely essential. And that brings us to the big, final question. We've just mapped out this incredible machine that's been built and refined over centuries. But with things like digital currencies and decentralized finance exploding onto the scene, you have to wonder which of these fundamental building blocks, the pipes, the valve, or the fuel tank, is going to be the first one to be completely reinvented. That's the real question for the coming decade.